Hello everyone, welcome to EPK Capital. Here we simplify investment and wealth management so you can build wealth for generations. What if I told you that you are paying someone a lifelong commission? A commission that costs you lakhs, maybe even a crore, for a service you received only once, years ago. This is exactly what's happening to millions of investors in India right now. They've bought something called a regular mutual fund. You see, in investing, the smallest leaks sink the biggest ships. And today, I'm going to expose the single biggest, most common leak in your portfolio. It's the difference between direct and regular. And it is the most expensive one-word difference in finance. Direct versus regular mutual funds. The small difference that costs you lakhs. Alright, let's get straight to it. When you buy mutual fund, you have two options for the exact same scheme. Same fund manager, same stocks, same portfolio. Option 1, the regular plan. This is the traditional way. You buy through a distributor, a bank's relationship manager, or a broker. Option 2, the direct plan. You buy this directly from the asset management company or through a SCBI registered investment advisor or a discount broker. The difference isn't the fund, it's the cost. A regular plan has a hidden, embedded commission that is paid to your distributor every single year. This isn't a one-time fee. It's a trail commission. As long as you stay invested, that distributor gets a piece of your investment year after year for doing absolutely nothing after the initial sale. This commission is bundled into something called the total expense ratio or TER. The direct plan has no commission, so its expense ratio is always lower. This difference might look small, maybe 1%, 1.25%, but in wealth management, 1% is a gargantuan number. Now, let's talk about the real cost. Your distributor will tell you 1% is a small price for their advice. I'm going to show you the math they hope you never do. This 1% isn't just 1% of your profit. It's 1% of your entire accumulated wealth, deducted every year. It's a direct attack on the power of compounding. Let's take an investor, Rahul. He starts a 10,000 rupee monthly SIP for his retirement 25 years away. He expects a 12% average annual return from his equity fund. Case 1, regular plan. The fund's gross return is 12%. The regular plan's expense ratio is 2%. His net return is 10%. Case 2, direct plan. Same fund, gross return of 12%. The direct plan's expense ratio is 1%. His net return is 11%. Only a 1% difference, right? Let's run the numbers. Look at that. Over 25 years, that small 1% leak has cost Rahul 25 lakhs. That's not a small fee. That's a new car, a foreign education, or a significant part of his retirement gone. It gets worse for lump sum. Let's say you invest 5 lakh rupees and forget about it for 30 years. A regular plan at a 10% net return gives you 87.2 lakh rupees. The exact same fund as a direct plan at 11% net return gives you 1.14 crore. The difference is 27 lakh rupees. You've paid a broker 27 lakh rupees for one transaction 30 years ago. It's financial malpractice hidden in plain sight. So why does the regular plan even exist? And why are you sold them so aggressively? Simple, a massive conflict of interest. A distributor or bank's primary incentive is to earn that commission. Are they recommending the best fund for you, or the fund that pays them the highest commission? This is why you'll often see banks pushing their own AMC's funds, even if they are poor performers. Their loyalty is to their own revenue, not to your portfolio's growth. A SCBI registered investment advisor, on the other hand, is legally bound by fiduciary duty to act in your best interest. They cannot earn commissions. You pay them a flat fee for their advice, and they will always put you in a direct plan. The incentives are aligned. So, what do you do right now? Here is your expert-level action plan. Step 1. Audit your portfolio. Now, log into your investment platform. Download your portfolio statement. Look at the name of every single fund. If you see the word regular or reg next to it, you have a leak. If it says direct or DIR, you are safe. From now on, never buy a regular plan again. You can buy direct plans from the AMC's website, registrar platforms like CAMS or KFintech, zero commission platforms, or through a fee-only RIA. You don't need to sell. You can switch your regular plan to a direct plan. Critical warning: A switch is legally a redemption from the regular plan and a purchase into the direct plan. This means you must check two things. 1. Exit load. Are you within the 1-year exit load period? If yes, you might pay a 1% fee. It might still be worth it, but you must check. 2. Capital gains tax. This transaction will trigger capital gains. If you have held for less than a year, you pay short-term capital gains. If more than a year, you pay long-term capital gains. My advice? For any fund you've held for over 1 year, the tax implication is usually a small price to pay to stop the permanent lifelong commission leak. Consult a tax advisor, but in most cases, the math is overwhelmingly in favor of switching. In your wealth journey, you must be the defender of your own capital. No one will care about your money more than you do. The choice between direct and regular is not a small detail. It is the foundation of efficient, long-term investing. Don't pay for silence. Don't pay a lifelong commission for a one-time sale. Go direct, plug the leak, and claim the lakhs that are rightfully yours. Check your portfolio. Are you in a regular plan? Subscribe for more no-nonsense advice on building real wealth.